that first one, what does it say? Let's read us into it.
Carey Corporation purchased 2,000 shares of the outstanding common voting stock on December 2, 28th at a cash cost of $9 per share as very short-term investment.
As a very short-term investment. So, they bought how many shares?
2,000.
No, I touched that. 2,000 shares. And how many shares are there? This is how many they bought. And there are 1 million shares? Shares. That's 1 million shares. So what percent of the company they own? Not much. Little tiny investment. Okay. So what would you say about this? Just 1 million shares.
No control.
No control. Absolutely. So that's the first decision you make. No control. So therefore, it is going to be what method are we going to be using? Market value. Excellent. So we're going to use the market method. Mark to market. Okay. And then we need to ask ourselves one other question that it's going to be in that category. How long? So what does it say? Very short term. Yeah, very, very short term. So what would you say that probably?
Because then it says only plans to hold investment for 1 or 2 months.
Yeah, that'd be pretty screwed. Yeah, that would be pretty screwed. It's still pretty screwed. I'd go pretty screwed. Okay? And I'll tell you, it's less than a year, it's, available to sell short term. Okay. Or more than a year, it's available to sell long term. So yeah, very short implied trading security. So what do they want us to do? Oh, what was it? $9 a share? It's the purchase price, right? Okay. $9 a share, 2,000 shares. That's 18 grand. Okay. What else do you know?
Million outstanding shares at dollar par value.
Okay. $1 par.
At year end, December 31st, 28th, Fonzie reported net income of $700,000.
Okay, their net income is 700 grand.
And declared and paid a $188,000 cash dividend.
Okay. Dividend in cash, 180,000. Okay. Okay.
And December 31st, 28th, market value was $8.
So it goes down to $8 per share at the end of the year, right? Okay, so they only held it for a period of time, right? Obviously. So, all right. So then, what does it require?
Give it all entries.
All the entries you're supposed to do. What will you do at the date of purchase?
Credit cash.
Credit cash. How much? 18,000, right? 2,000 shares at $9. You guys agree? No big deal, right? I guess I should have said this is number 1 when that summer quiz, 12 through 14, whatever it is. Okay. All right. And then 18,000 of what? Trading securities.
Okay, securities.
Yeah. So investment in trading securities is just fine. Okay?
Do we need to put short term or long term for you?
No, not for this because it's automatically short term trading securities. You don't want to do that, right? You don't need to. Okay? That's like saying, do I need to say short term on cash? Right? You know it's current. Okay? On a bill for sale, you got to tell me because they use the same name for short term and for long term. Make sense? Bill for sale, short bill for sale, short term or available for sale, long term. Okay, what else do you need to do? At year end, what do we have?
The $1 loss.
Yeah, we get the $1 loss. So what do you want to do?
So,
Let's do here.
that's loss on investment valuation.
Yeah. Okay. And what would that be? Debit or credit if you have a loss?
The debit.
Debit. Yeah, just like an expense. Loss and that, by the way, that's an income statement account, right, guys? Goes the income statement, right? Because we're only gonna hold it a short period of time, so we don't think we're gonna recover the loss before we sell it. That's the idea, okay? So how much is that? $1 a share times 2,000 shares, 2,000. What's your stock worth now? 8 times 2, right? 16,000. So we put 18 in there, and now we're going to take 2 out. That makes sense. So it'll be the 16,000 in the account, huh? Okay. And that's just going to be trading securities. Got it. Pretty easy, isn't it? Okay. All right. And then what else happens? I don't think so.
How's a dividend?
Net income and dividend both. Dividend, we're going to make an entry for, aren't we? Very good. Okay. So this is the decline in market value here, and then this is the dividend. What's the dividend does? Because we're just taking whatever they give us, right? How much dividend would we get, by the way? You take your 180,000 and divide it by a million shares, couldn't you? How much is that per share? 18 cents? Times 2,000 shares. What's that? 18 cents times 2,000. 3,600. Really? That's $1.80 a share. 18 cents. $360, isn't it?
$360.
Yeah, 360. Okay, what did they give us? Cash. Debit cash. 360. And credit what for 360? I earned dividend revenue. Right, guys? Then just take what the market gives me. So I have my dividend revenue, and then I have a loss on the declining value. Right? The dividend revenue is still additional revenue. Okay? Are we good? And then what would you do with the net income?
Nothing, because you're not a influential or...
Yeah, you got it. No entry. So if I list it there, say no entry, okay? No entry because I'm not running the company. I'm just taking what it gives me. Pretty straightforward, guys. So that's hard. But that's the whole problem. Okay, good. All right, what if this had been, what if I was going to hold it for more than a few months, you know, more than a few weeks, few months, whatever, but less than a year? What would I change? Trading securities have become what in every case?
Affiliate trading.
No, affiliated is if I have significant influence, more than 20%. So let's say we still only had 2,000 shares out of a million. What would it be?
Available for sale short term?
You bet. So I changed trading securities to available for sale short term there. I'd be available for sale short term there. I'd have an unrealized loss on available for sale short term, but if that would not be an income statement account, it would be a equity account, other comprehensive income, right? Okay. And otherwise, everything just stays exactly the same. Easy, huh? What if it was available for sale long term? We'll call it long term instead of short term, okay? And exactly the same. So once you've got it, you know, you got made, huh? Okay. It's more than a year, it's long term. Okay. Let's try the next one. So, another shot. It's number 2.
On January 28, Pod Company purchased 70% of Saw Company stock for $200,000 cash.
Okay, now this is something we didn't get to in class. It's going to be new, okay? So let's go ahead and do it. Why not? Okay, so 70%. If I own 70% of their stock, I am control. I'm in control. Which means I am what and they are what? What would we call ourselves? We are the parent. Parents control their kids. No, they don't. But anyway, that's where it comes from. Okay, so parent and subsidiary. Right? Parent company and subsidiary. So I'm going to be the parent. They're going to be the subsidiary. Make sense? Okay. And what else do you know? We got 70% of what?
We bought it for $200,000, and the book value of their assets included land that had a book value of $70,000.
Okay, so I paid my investment, 200,000. I got 70% of their stock for 200,000. And then you say there's some land or something, building, what was it?
Land with book value of 70,000 and a market value of 76,000.
Now here's the deal. When you buy another company, you can revalue their assets. You can buy all their stock. You can revalue their assets. You wouldn't revalue yours though, right? But I'd revalue all of their assets. And so what I've done is I've just given you one asset that is where the book value doesn't match the market value. Just keep the problem simple. But what you do in real life is when you acquire another company like this, you revalue all their assets because it's a purchase of the company, right? And you know how much you paid for it, so you get estimates of all the values. Go ahead and record it. So we've got an increase in value here of 6,000. Now we don't do that on the subsidiaries' books. Remember, their land is sitting on their books, and the investment in the company is going to be on the parent's books, right? So it's weird, right? But we make this elimination entry in a worksheet. So what we'll do is we'll list the parent in 2 columns, the subsidiary in 2 columns, and as many subsidiaries you have, right? 2 columns each. We're going to add them all together, right? On a worksheet, just on a worksheet, okay? It's not in anybody's general ledger. Got the idea? Because they have all different general ledgers. So this journal entry doesn't go in anybody's books. It's just in, right? Are you guys staying with me on that? Does that make sense? It's just going to be for purposes of these financial statements. Okay? Work paper, journal. What we're going to do is we're going to eliminate the investment, and then we're going to eliminate all the equity of the subsidiary. So the subsidiary doesn't exist. We own it. That makes sense? And we can't have an investment for ourselves. Okay? So that's what the elimination entry is going to do. When we eliminate, we will increase that land by the $6,000. That's where we show the change. We don't go and change it on their books. Okay? Because they didn't sell the land, right? We bought the stock. So that's the deal. Okay. So that's where we're at. What else do we know?
The equity consisted of $90,000 common stock.
Okay, so now this is going to be our investment on the parent's books. On the subsidiary's books, the company that was purchased, right? So that's my investment. What I paid is my investment. Okay, on the subsidiary's books, what I'm going to have is common stock. That's their equity. How much?
90,000.
Okay. What else do they have?
Retained earnings, 160,000.
Okay, now I made this real simple. Could there be more equity accounts? Sure. Additional paid-in capital, retained earnings. I'm sorry, additional paid-in capital, preferred stock, additional paid-in capital on that. There could be more, right? Okay. Right. And then what else do we know?
That's it.
Okay. If I own 70%, how much do the minority shareholders own? 30. Yeah, no kidding. Right? So we already know we're going to have a minority interest equal to 30%. Are you good? Is that okay with you guys? Common sense. Okay, I'm going to want to eliminate this, and I'm going to want to eliminate the investment. Well, first, let's record the investment. Did it ask you to do that? Probably.
Yeah.
Let's record the investment. This is going to be on the parent's books, of course, right? The investment's on the parent's books. How would we record that investment on the parent's books? What did they give for the stock? You got credit cash? You guys buy into that one? Okay, and debit what? Investment in subsidiary, maybe the company name dash subsidiary. Does that sound good? You might have more than one subsidiary. The company name on it. What was their name anyway?
Solid company.
Sodco. Not an affiliate. An affiliate would be 20 to 50% significant influence. This is a subsidiary. Okay? So call it a subsidiary. Okay? That's what the sod company subsidiary, 200,000. Shut up, please. Just that a little bit. Got the idea though, guys? So far, working good? So now it's recorded on this is what's recorded in the parent's books, right? And this is what's recorded on the subsidiary's books over here. You see it? And we want to increase the land by 6,000. Okay, so what would our elimination entry look like? What they want us to do is an elimination entry. What I want to do is fix that problem. Do an elimination entry. Again, it's on nobody's books, right? want to eliminate? Well, I do want to increase land 6,000. I'll buy that. So what do? Increase land. Remember, I'm adding up to two companies. I'm adding the land from the parent and the land from the subsidiaries. Add enough. As many subs as I have. Add up all their land, right? But I think this one should be revalued by 6. So what do you want to do to it? I want it to be higher. Debit land 6. No kidding. Right? Like the debit land $6,000. Well, what else do I want to do? If I have the companies together, do I want to have investment in subsidiary on the combined? Does that mean investment in subsidiary and I put on my statements that it's consolidated statements, which means it includes all the companies? What is that, an investment in myself then? So you have to get rid of it, right? That's it. So how do you get rid of it? It's a debit balance. How would you get rid of it? Credit. Investment. No kidding. It's that simple. Inside company, which is the subsidiary, right? So all my subsidiaries I'm going to eliminate. How much is it on the books at? 200,000. So take the 200,000 out. And by the way, it would change every year. Different numbers. So you probably use the equity company account. Okay. Then what? I won't bother you about that. Then what else do I want to do? The subsidiary doesn't exist. I want to get rid of it. So I got rid of this one. I got rid of this one. What do I want to do? How would you get rid of common stock? Because I'm adding all the common stock of all the companies together, but all I want left is the parents. Well, how do I get rid of the subsidiaries? I'm not taking it off their books, right? Just doing this in this elimination entry. I'll debit it, right? Debit common stock. 19,000. And never retained earnings. All the equity accounts, right? You get rid of one. Huh. Well, what else do I have? That doesn't balance, does it? Also, I only bought 70% of it, didn't I? You guys were with me? Back to that. We bought 70% of this, didn't we? So if I bought 70%, what did I really buy? What did I buy? Let's see. How much equity did they have? What was their equity? What did we say it was?
Total was 250.
It's 250, isn't it? So there's 250,000 of equity. And I'm buying how much of it? So let's see what I buy. Total equity. This is a subs equity, right? It's 250, and I bought 70% of it. How much is that percent? 175,000. Well, what's the other 30% or 75,000? It's the minority interest. You got it. So I already know the minority interest is 30%. And 30% of the 250 would be 75,000. Okay. Now, what did I get for that 175,000? See how this is going to work.
So where do we get this 250,000? Still not making up.
The 250 is their common stock plus their retainer. Their total equity. Subsidiaries total equity. Okay. How much did I pay for this company?
200,000.
Oh, wait a minute. If this is the purchase, the equity I purchased, that's my equity I purchased, right?
Yeah.
You guys agree?
Yeah.
I bought 70% of the company, but I paid my investment was 200. I paid too much, did I? No, I probably paid market value, right? That's what you pay when you buy stock. So I have an excess that I paid of 25,000. Everybody see that? If you gave 200 for something that has a book value of 175, you paid 25 more than book value, right? Now what does that consist of? Oh, I had to buy the land. The land is worth more than it's on the books at, right? And if you increase the land on their books, it would increase the equity in their books, right? Have a gain. Okay, so instead of doing that, I'm just going to increase the land in my elimination entry. So I'm going to take this 6 out of here, right? call this, you guys, is goodwill. Yeah. We did goodwill a little bit when you read about intangible assets. Remember that? You look at goodwill. What's goodwill? When I buy another company, right, and I pay more than the fair market value of all their assets, less the fair market value of all their liabilities. In other words, I pay more than the real fair market value of the equity. What am I buying? Oh, there must be another asset named goodwill. So I'm buying another asset. What is goodwill? My customers, my vendors, my employees, my relationship with the government. You know, everything that's not on my balance sheet, in other words, that's of value is what I'm buying. Does that make sense? So the only place you get goodwill is when you buy other companies, because that's the only time you can measure it. Now, do most companies have goodwill? Although maybe some have ill will. Do you have a favorite restaurant?
B-Dubs.
Who is it?
B-Dubs, Buffalo Wild Wings.
Oh, yeah. I went there with my grandson the other day. You know what? You know why he wanted to go? My wife and granddaughters and my daughter were down in Nashville visiting. My sister-in-law was there, so they went down and played to Nashville. And my sister-in-law was out at a conference. But anyway, they were out of town, so we went. We were going to watch the game, but we didn't end up staying that long because we were too early last weekend. And he wanted to go there because they have video games that you can play, right? And a little handheld thing. They have the ones on the tablet, yeah. They have for the kids. They do all kinds of games. So yeah, he's 6. It's just intense. He would have stayed all day. It was just fine for him. Anyway, they have really good pickles. Fried pickles are really good. Yeah. I'm not much for wings. I like chicken. Fried chicken. Okay, so why is it your favorite place?
65-cent boneless wing Thursdays.
Yeah. You know, you think about it though. It's that, right? You like the food, you like the atmosphere, you like all the cute waitresses, whatever. Okay, you know, but don't they have the same tables and chairs and building and plates and stuff that any other restaurant would? And there are other restaurants that you don't even know who they are, or you don't like them because you went there and it wasn't any good, you know, or they charge too much, you name it, right? And there's a reason your favorite is your favorite. Well, there are a lot of people's favorite place, right? Or one of the favorite places for a lot of people. And that's goodwill. Because they got the same stuff, right? The same building, basically, you know. So it's the add-on that you have is the goodwill. Does that make sense, guys? So yeah, businesses develop goodwill as they're operating. The problem is we can't measure it, so we don't record it. Otherwise, what would you do? Debit goodwill and credit gain from increasing my goodwill? That'd be kind of weird. Everybody would guess they had a lot of goodwill then and record it, wouldn't they? So the only time you can do it is when you buy it. Okay, anyway, so I want to get the goodwill recorded, so I'm going to debit goodwill. It's an asset. And the goodwill is how much? 19,000. So you can see between the 19,000 here and the 6,000, I've got that 25 taken care of. Got it? Now, does that journal into balance? No, what's wrong? What do I have? I have 250 or 150, right?
Yeah, 150 plus.
I'm sorry, I have 250 retained earnings and common stock plus 25. I have 275 there, and this is only 200.
Yeah.
I need 75,000 to make it balanced, don't I?
That's the 30% minority.
Yes, it's the minority interest. We got to think. And why are we doing this? This is something like, it's not a liability, I don't own the money. Something like equity, except it's not really equity because they don't have any vote, right? So I have a separate line on my balance sheet in between total liabilities and equity, right? I list minority interest in all the subsidiaries added up, listed there. It's the stock in my subsidiaries that's owned by somebody else. Got it? Because I want to include all their assets. When I add the statements together, I want to include all their assets, because I control them. Own them. Okay? So could you pull this off, you guys? And it's better. It's not the book. it's kind of fun. So it'll be an advantage if you came to take that. So take a look at that. Play with it a little bit. Okay. So, and that's what that one would be, huh? Okay. Is there another problem there? I think there was one more that related to this chapter.
Bought 40% interest in voting stock of Hop Corporation's $1 par value for $4 million.
Okay. So we invested $4 million.
40% of their stock, and it says 1 million. Yeah, 4 million. 1 million shares at $4. Market price.
So we gave them $4 million for 1 million shares, and then we said that was 40% of their stock. 40% share. Okay, now you think about that. 40%? What do you think it is, guys? You don't have control. It's not 50. Yeah, and it's not. We're not passive investor, right? We have significant influence. Yeah, you got it. Significant influence. So what method of accounting am I going to use here? When I own more than 50%, I consolidate it. When I own less than 20%, I use the market method, right? What am I going to do here? It's called the equity method. Okay. We did this today. So let's give this one a shot. At the date that we buy it, what do? Debit what?
Investment in affiliates.
Yeah. Investment in affiliated companies. And put the name down if you want. What was their name? Pop. Okay. Popco. All right. So whatever the name is. $4 million. Credit what? Okay. Then what happens?
On December 12th, Hop paid a 1.8 million cash dividend and post-reported net income for the year ended December 31st, 2008.
And how much is that?
5.6 million.
Okay, so the net income I earned 40% of it, didn't I? That's mine. So that's the way we think about it. So that's going to increase my investment, and it's going to increase income on the income statement, right? I'm going to record it. Just like a gain or a revenue or something. Okay. And then the $1.8 million dividend, what's that going to be? 40% of that's going to give me cash, right? And that's reducing my investment because I'm paying myself a dividend. So what do you think about it, huh? So here you got this investment account with $4 million in it. Investment affiliate. $4 million in here. Okay. From this. And now I'm going to increase it for my share of the income, and I'm going to decrease it for my share of the dividend. Okay. So let's do the we can do the dividend first. That's fine. What do you want to do? How much cash am I going to get? I own 40% of the company, you guys. You can either figure out what it is per share if you want, right? Do that. I have 40% of the company, and it's 1 million shares or something. So how many shares are there? What's that?
720,000.
Yeah. What do? You take what? 1.8 million times 0.4?
Yeah.
Yeah. Okay. That sounds good. 720.
Yeah.
And credit what? Investment in affiliate. Same account. Because I am paying myself back some of my investment, basically.
You know the dividend? You don't include the dividend?
That's just the dividend. Yep. That's the dividend. This is buying in the first place, right? Investing in the first place. Okay? So what's happening is I'm saying, look, my investment has 720,000 less in it because I gave it to myself, right? I voted to give myself that. I have significant influence, okay? Right? Is that making sense, guys? And then the net income. What do we do with the net income?
Credit. Or debit. Cash for.
Well, I'm not giving you cash.
Dividend revenue.
Okay, so that's going to be a credit, not dividend. We're doing net income now. We already did the dividend. This was the dividend here, right? This one was the dividend. So what are we doing with the net income? I earned 40% of that income. How would you reflect more income? Credit. So equity interest in affiliate income, something like that. You can use all kinds of different names, which you could use for our purposes. This is fine. Let's just call it income from affiliate. You like that? Income from affiliate. So it from affiliate. Got it? So how much is it going to be? It's 5.2 million. I own 40% of it. What's that?
2,080,000.
Okay.
Divided by 4.
I take it times 4. 5.2 million times 0.4, right? Times 0.4. That makes sense? The way we got the dividend, our share of the dividend was 1.8 million times 0.4. 40% of it, right? 2,200, is that right, guys?
Yeah.
Okay, and what's that going to be debited to? I'm increasing my investment because I earned that much, so I think my investment's going up. Value. The stock might not even be publicly traded, right? So, investment in affiliate, same account as this one, right? Same deal, same as that. And we're good, huh? So what would be my ending balance in investment in affiliate? 4 million plus 2,080,000 less 720, right? How much is that? 6, 5, 5, 3. No. Yeah. 5, 3, 6, 0. Know what that is? 4 million plus 2,080,000 less 7. Easy? Is that right? Is that right?
Yeah, that's right.
You guys good? Making sense? Oh, did they tell you what the stock price was?
On December 31st, stock was trading at $4.20 a share.
Okay, so at the end is 420.
It was 4 at the beginning.
So did they make 20? Did they have an increase in value of 20 per share? At the end of the year, it's 420, $4 at the beginning of the year. They made 20 cents a share, right? Increased market value times their shares. But do you do anything with that? No. No entry for the change in market value, right? You're glad it went up in value. You'd be sad if it went down in value, but you don't record anything. Why not? Because we're recording the net income, right, as income, not the change in market value. It's not the market value.
So for equity method, are the entries only dealing in the investment and affiliates?
Yeah, yeah. Equity method is only for investment in affiliates, although an investment subsidiary you can use that. Yeah. And then for the trading securities, though, available for sale, that's market, right? Yeah. Good? Easy?
Not too bad.
Okay. You just got to keep it straight, right? Okay. Want me to make you a problem? Good. We got a few more minutes. Let's do another one of the subsidiary ones because we just did that. So let's say XYZ company buys 80% of the stock, 80% of the ABC company. Okay. So XYZ is going to be the what? They have control, and they're the parent. That you got it. Control because it's over 50%. They're the parent. Good. And ABC is going to be the subsidiary. And there will be a minority share. Yeah, we can do that right now too. Whatever order things pretty. So there's going to be a minority share. What's the minority share going to be? The minority interest is going to be how much? 20%. 20%. So you already know that. Excellent. Okay. And let's say ABC company, their equity looks like this. They have 100,000 shares, okay, total. The market value at the time of the purchase is $10. The market value at the end of the year, we don't know, because it's not being traded. Okay? And even if you did know the ones that are being traded, it's only 20% of it, right? So, it doesn't matter, right? It doesn't matter on subsidiaries, just like on the equity method, right? Okay, and then let's say we could have net income. We could have the dividends if we want to pay ourselves some dividends, I guess, take some money out. But let's just leave that out of the problem. In fact, probably if I was giving you a problem like this, I wouldn't give you this stuff. But you need the $10 we paid, I guess. So $10 per share. You better have that, so you know how much we gave. Huh? Okay, about 80%. And then let's say that that all their assets are the book value and the market value are the same, except for a building they have. It needs to be increased in value by 10,000, right? Maybe it's on the books at 100, it should be the market price. Okay, so we're going to increase the building by 10,000. So we got that. And then let's say they have common stock. It's $1 par, so it's $100,000. And then even though the company's worth what, $10 a share times 100,000 is $1 million, right? And then let's say their retained earnings is 500,000. Okay, that's it. So record the investment first. That'll be on the parent's books, right? So in the parent's books, record that investment first. Give me that journal entry, and then give me the elimination entry. You do it. Just get it. Tough. Think about that. The investment's pretty easy, isn't it? What would you do for the investment?
Take 80% of 100,000.
That's 80,000.
80,000 times the $10 per share, so that's 800,000.
800,000. Yeah. Devil what? Great.
Subsidiary ABC.
Investment in ABC subsidiary, something like that. You like it? Or investment subsidiary in parentheses ABC, maybe. Okay. So what did you say that was? 800,000. And credit? Cash. 2,000. Okay. Elimination journal. Let's take a look. What do you want to eliminate? I want to increase the value of the building. So, what do you want to do? How do you increase the value of a building? Debit building. Yeah, no kidding. Okay. We got 10,000 going in there. Oh, that's fine. Good. What else do you want to do?
Debit common stock and retained earnings.
Yeah. Why are you doing that? You want to eliminate their equity, right? 3,000. This is bad. 500,000. So now we don't have their equity anymore, right? Pretty good. 610. What do we need to get rid of? Now those were on the subsidiaries books, right? This is all subs books. Everybody agree with me on that? It's ABC subs books. Yeah. Okay. Subsidiary there.
The minority.
You're going to want to record a minority interest, debit or credit? Yeah. It represents the portion of the stock you don't own. What portion don't you own? 20% of what?
100,000.
Just 100? Really?
10 million, 1 million, something like $200.
20% of those shares, that's true, but all of the $1 million? Is that what it is, really?
Yeah, you can credit the minority interest for 200,000, right?
Really?
Or no, you wouldn't.
I don't think so.
Isn't it going to be like
What'd you buy, guys? You bought the assets less the liabilities of the company, didn't you? That equals their equity. What's the total equity of the company?
600.
It's 600. You bought how much of that 600? 80%. How much didn't you buy? 20%. So what's 20% of it? Oh, it's 20% of the 600. That's 120,000. Right? It's the book value of the equity that they own. Okay? So the minority interest there is 120,000. Oh. But what did we buy? Let's see, we bought what portion of it? 80%, right? How much did we buy of the equity?
480.
480. Ah, okay. So that's our share of the equity. You guys with me? And what did we pay for it?
We paid $800.
Yeah, we paid 800 grand for that. So somehow this company's worth a lot more money than its book value, right? Can that happen? Absolutely. So what's the excess we paid? This is my investment. Well, it's 320, but is that all goodwill?
You reduce the increase in value of building?
Yeah, I already increased the value of the building, so I better take away that. Good. So what do we have? 310 of goodwill. And you'll know if you did it right or not because your journal entry won't balance if you didn't do it right. It's kind of nice, huh? So what do I need to record now? It's two pieces. You guys want? We did the minority interest, right? What else do we want to do? Record goodwill, right? How much? 310. Does our journal entry balance? I don't think so. How much is it off by?
Probably would it be the 20%?
No, we put that in. That's the minority interest over here.
Our investment.
Oh, our investment. Yeah. What are you going to leave the investment on the combined books? So you recorded, when we put it together in consolidation, you now have minority interest, you got rid of the equity of the subsidiary, you increased the building, and you recorded goodwill. What did you not do? I let you guys just hang there with that one.
Did you parent interest?
Yeah, you better get rid of that. Remember, this doesn't go on anybody's books, right? It's just on a worksheet. Because these accounts, all of this stuff over here, goodwill is on nobody's books, right? The building is 10,000 less on the subsidiary's books, so we want to add the 10. The common stock and retained earnings stay on the subsidiary's books. We're not going to get rid of it. Just in the worksheet, we're getting rid of it, okay? So, and the minority interest is only in the worksheet we recorded. So don't you have to get rid of this investment? Sure. Investment in ABC goes away. So, right? Get rid of that. Now do we balance? Yeah, we're brilliant. So you can't leave anything out. Just make sure your debits equal your credits, right? And you'll pick up the pieces you're missing.
Yeah, I mean, at that point, you just added those, subtracted 120, you get 800.
Yeah, yeah. But probably you'll remember to do the 800. Probably you'll remember to get rid of the equity. I bet the only one that'll give you any difficulty is maybe getting goodwill, huh? So you'll know this one. This is pretty easy to compute, right? You know, and these you know to get rid of. You'll know to increase whatever asset I give you. It could be a bunch of them, but I'll just be
So it's almost like you don't even know.
what's left.
You might not even need to calculate goodwill.
Yeah, not really, except you make sure all your answers are right. You know what I mean? You know every number's right, I guess. So, and seeing as you're going to take 20% of that number anyway, why not take 80, right? And get your excess, and then just take away, change to an asset. See it? Makes sense, doesn't it? Huh?
Yeah, it's quite a day.
Quite a day. Took a lot at you. Well, we got another day we can talk about this stuff too, right? Want to do one more? Any energy left? No, I don't. Okay, I hereby decree I am going to keep this bond for here's what happens with the bond. It pays 10,000. Oh, yeah, pays 10,000 interest this year. And you will just say we get it by the end of the year, okay? I guess we better buy it in the first place, huh? Purchased for $100,000. Which is, it really doesn't matter if it's the face amount or it's a discounted premium. It's what we pay. It's not going to matter here. So we purchased it for that. It pays this much interest. And then its market value at the end of the year is $102,000. If you want, the company that issued the bond has $250,000 net income, and the company pays $100,000 in dividends. Give me the journal entry to purchase it in the first place, and they give me the journal entries at the end of the year. Record the investment, purchase of the bond. So what do you have to ask yourself? What's that?
You know, we try to find the present value of the.
No, we don't. I know the present value, but I'm buying it for $100,000. I gave it. Don't mix it. Is this a held to maturity bond? 20-year bond, you're only going to hold it for 5 years. So what is it by definition? How much control do you have?
20%.
How much control of the company do you have when you buy a bond? None. You have no control. Right? Tricky. Yeah, tricky. This is kind of fun. Yeah, I'll have to give some license. Okay, I don't think I've ever used a product like that. Okay, it's a bond, right? Yeah. They don't have any votes, so no control. So now what am I going to do? What does it have to be? It's going to be one of three things. What is it? It's a marketable security, right? Because I have no control. Just like I own less than 20% of stock. Okay, this is debt, so any amount of debt is no control, right? All right, so what are the three things I could call it? I'm going to hold it for a real short period of time. Trading security. I'm going to hold it up to a year. Available for sale. Short term. I'm going to hold it for more than a year. Available to sell long term. What is this thing? 5 years. Yeah, available to sell long term. Do the interest. See? So less than 20% or debt. Yeah. So do the purchase. What would you call it? You got it. Debit investment. And then available for sale long term. This is easy, isn't it? Once you get your head around it. That was $100,000, was it? Yes. And credit, cash probably. Okay, good. What do you want to do? Let's say the dividend came at the end of the year and the interest came at the end of the year. So.
But you don't do it according, right? It's a bond.
You don't get any dividends, so nothing for dividends, right?
Nothing for anything.
How about the net income? I don't have any control.
Nothing.
No entry. That'd be easy, right? Ta-da! Okay, we're done with that one. Now what? You get interest. What are you going to do with the interest?
That's dividend revenue.
But it's not dividend revenue, it's interest. How about calling it instead?
Interest revenue?
Interest revenue. There you go. You know, it's funny, we do these in different chapters, and it's kind of like, I can do it in one chapter, but I can do something, I go to something else, and it's gone.
Yeah.
Yeah. It'll be fun when we do the final. I mix stuff up a little bit, I think. Okay, so then what? Debit what? What'd they give me? Cash, of course. Okay, so I got my interest. Ta-da. You got that one. Good. What else do you need? Oh, the market value at the end of the year. What are we going to do with market values? If it was stock, we'd adjust the new market value, wouldn't we? What do you do if it's a bond? Exactly the same thing. How could the market value go up? The effective interest rate out there did what? Up or down?
Goes down.
But down. Yeah, the effective rate went down out there and made your bond more valuable, right? Because your interest rate didn't change. Absolutely. So what do you want to do with that? We still want an entry for that, don't we? It made a $2,000 difference in its value, didn't it? So what do you do? What do you want the investment to be now, guys? Yeah. How do you make it 102 if it's 100? Debit investment. And develop for sale securities. Isn't it? Long term. 2,000. That'll make it 102 now, won't it? And in credit what for 2,000? I haven't sold it. So this is not realized, it is unrealized gain, right? Unrealized gain on what? Available for sale long term. Got it? Okay. If I'm going to hold it for less than a year, I'd have investment in available for sale short term, right? If I'm going to hold it for a very short period of time, I use trading securities everywhere. Okay? Trading securities. And this account, it goes where? If it's available for sale short term or long term, either one, it goes where? Other comprehensive income in the equity section. Directly to equity, right? If it was a trading security, that'd be an income statement account, right? Maybe at the top of the screen. But it makes sense. If it's a trading security, you think that you're going to sell it before the value changes, right? So if you think a loss should be recorded in the income statement, right? That's the income statement. And if it's available for sale, you think it, it might recover, you don't have the loss locked in, or the gain locked in, whichever it is. Does that help a little bit on that? Isn't it funny? We went over this in class, and you guys all had glassy looks in your eyes, and now you know it. It's nice having young brains that are working. And you concentrate on stuff, pay attention to it. Now go practice it a little bit, right? And you'll nail the quiz. Like we did on the equity one. That's fun. You guys do it. I'll do quick, okay? Not bad. Did good. You did good, didn't you? Yeah, you did. 15's are the high, so you guys are up there. You did
I didn't do as
good.
good as I wanted to, but I mean, if 15 was the high, I did pretty good.
Yeah. There were a couple of them really pretty good.
Who got that? That girl that's in behind?
Three people. None of you guys got a 15? I got close.
I got what?